Good day, I'm Alan, and in this video, we're going to talk about my favorite index trading strategy. So it's very simple, very easy to follow. So to start, let's first define some terms. So we define what this mean. So as we know from our statistics classes, mean is just basically the average. And then we need another term which is standard deviation. So basically standard deviation is just how far how far our values from mean. So these are the terms that we're going to need, mean and standard deviation. We're going to use these terms for our strategy I call leverage bounds. Okay, so we're going to use some leverage and we're going to trade the index. So how do we do this? So this is a Python code I made that calculates the beta and Sharpe ratio of a certain stock, and this is also applicable to calculate the beta and the Sharpe of index funds. So in this formula, in this code, we use SPY as the SPX or SPY as the base base ETF, and we're going to use TQQQ, which is the 3 times leverage Nasdaq, and the UPRO, which is the 3 times leverage SPY. So computing for the beta and the Sharpie of the TQQQ, we can see that as the SPY moves, TQQQ moves 3 times, 3.13 times the move of SPY, and UPRO moves 3.0091 times the move of SPY. The leverage bounce is trading leverage index using these two values, standard deviation and the mean. So let's go to chart and see how we use the mean and standard deviation. Okay, join for free. Let's go to chart now. Trading for next level, reload. So this is just the default view of trading view, and we have here the chart of the Nasdaq index. You can also see the chart of the SPX or the S&P 500, but I'm more fond of the tech stock, so let's use IXIC for the Nasdaq. So in calculating the mean, we can use indicators such as moving average. Moving average is basically a mean, but we also need the standard deviation, so we have an indicator for that called the Bollinger Band. Let's employ Bollinger Band. So if you can see, the line here is the mean, and the two lines above and below the mean are what we call the standard deviations. These two lines are 2 times the standard deviation. Okay, so now that we plotted the standard deviations and the mean, here goes our strategy. So the leverage bounce is useful for when the price of the index fund, the price of the index goes into the 2 times the standard deviation below. So this for me is a buying point. This point is a buying point. Uh, Whenever the price of the index goes into the 2 times below standard deviation, that's a point where I want to buy the fund. And then whenever the index goes 2 times above the mean, 2 times standard deviation above the mean, that's where I sell. here. Possible selling point. This is a possible buy point. Possible selling point. So that's how my strategy works. This is the example of the Nasdaq 3 times leverage index. We can also do this for the SPX. The ETF for the 3 times SPX is UPRO. So we also have, let's look at the SPY. SPY, so basically that's it. And then, but I'm not going to buy the SPY or the IXIC index fund. I'm going to buy their 3 times leverage ETF, which is TQQQ for TQQQ for NDX. This is just one of the choices. UPRO for uh, SPX. Okay, so that's it. That's my strategy called leverage bounce.